Welcome to vTalkInsight, Risk Sentiment Daily for December 24th, 2025. Global equities are holding near record highs, volatility is pinned close to the lows of the year, and AI remains at the center of the market narrative. Today we will unpack how that optimism sits alongside rising macro, valuation, and geopolitical risks that could quickly change the tone. Risk sentiment today is best described as constructive risk-on, with a clear but cautious bias toward owning growth and cyclicality. U.S. equity benchmarks are hovering near all-time highs, with the S&P 500 up close to the high teens year-to-date and the Nasdaq 100 up more than 20%, reflecting persistent appetite for risk even after a strong run. The volatility backdrop reinforces that message. The VIX index has slipped to its lowest close of the year, and spot readings around 14 underline how little near-term downside investors are pricing in. Under the surface, market leadership continues to be shaped by AI and growth themes, but cyclicals are playing a bigger role. Global equities are being propelled by renewed enthusiasm in AI-related names such as Tesla, Micron, and NVIDIA, while demand for data center infrastructure and semiconductors remains exceptionally strong. At the same time, financials, industrials, and transports are showing improving leadership, and cyclical stocks are outperforming on expectations of continued capex and earnings leverage, confirming that the risk-on tone is not confined solely to mega-cap tech. Yet there is a clear layer of caution underneath the headline indices. Equity net positioning has slipped back toward neutral even as the S&P 500 makes new highs. Market breadth remains narrow with gains concentrated in large-cap tech and communication services, and safe haven assets like gold are chalking up record after record on concerns about debt, inflation, and geopolitics. Taken together, the picture is of investors leaning into the rally, but increasingly aware that rich valuations, policy uncertainty, and geopolitical flashpoints could turn a low volatility grind higher into a sharper repricing. The first major bullish driver is the AI-driven earnings and capex boom, which continues to anchor the equity story. Global stock markets are sustaining record levels on the back of renewed optimism in AI beneficiaries like Tesla, Micron, and NVIDIA, while demand for data center infrastructure is described as exceptionally strong and still in the early stages of a build-out cycle. AI infrastructure capex commitments on the order of trillions of dollars over the next several years are a key pillar supporting today's valuations, and equity multiples are effectively discounting that those announcements translate into real, sustained investment. Earnings dynamics help explain why investors are willing to pay up for this theme. The U.S. technology sector now generates roughly a quarter of S&P 500 profits and is growing earnings at close to 30%, outpacing the broader index and justifying a premium in the eyes of many allocators. NVIDIA remains the dominant supplier of AI chips, with demand in parts of Asia reportedly running more than 10 times available supply, while hyperscalers and big platforms are racing to secure both semiconductors and the power and cooling capacity needed for new data centers. This capex boom is spilling over into adjacent sectors and reshaping the future opportunity set. Major technology firms are pushing into clean and even nuclear energy, with deals such as Alphabet's multi-billion-dollar acquisition of a renewable developer illustrating the move toward vertically integrating energy supply to support AI growth. In parallel, large private AI companies are likely to tap public markets in the next couple of years as their data center funding needs outgrow private capital, potentially creating a wave of sizable IPOs that could reweight indices and offer new ways to access the theme, even as it tests the market's absorption capacity. The second supportive driver is resilient growth and soft landing hopes, particularly in the United States. U.S. GDP growth was revised up to around 4.3% in the third quarter, the strongest pace in roughly a year, driven by robust consumer spending and significant upward revisions to prior quarters. For the full year, growth is estimated in the low threes, with the current quarter still described as solid and supported in part by AI-related investment and broader capex, reinforcing the perception that the economy can sustain reasonably strong activity even as policy rates come down. Equity sector performance echoes that macro narrative. Cyclical stocks are outperforming, with investors expressing optimism about ongoing economic momentum and the potential for earnings leverage as capex spending persists, even though underlying growth drivers are characterized as modest rather than spectacular. Financial stocks have pushed to all-time highs despite consumer confidence readings near record lows, suggesting that markets see earnings resilience and adequate capital buffers as outweighing the softer mood in survey data. Looking ahead, this growth backdrop feeds into a soft landing base case in several outlooks. Strong GDP paired with generally stable inflation is seen as creating a favorable environment for equities into 2026, while default risks in fixed income are viewed as subdued and modest further moves higher in long-term yields are not expected, in these views, to destabilize risk assets. The caveat is that the GDP price index has picked up to about 3.8%, and copper and other industrial metals are surging on supply tightness and tariff concerns, so the line between healthy growth and renewed inflation pressure remains thin and worth watching carefully. The third key bullish pillar is central bank easing and liquidity, which provides an important backstop for risk assets. The Federal Reserve has already delivered about 175 basis points of rate cuts since last autumn, and there is an explicit readiness to move more forcefully, with some scenarios pointing to as much as 300 basis points of additional cuts if credit spreads widen or recession risks intensify. Recent downside surprises in inflation and a gentle rise in unemployment are adding weight to a more dovish tilt, while some Fed officials warn that keeping rates too high for too long could itself trigger a recession, reinforcing the case for continued, if gradual, easing. Market pricing reflects this easing bias, even if near-term expectations have been tempered by strong data. Implied probabilities for a January cut have fallen to around the mid-teens after the GDP surprise, but participants still anticipate 2 to 3 cuts over the next year to year and a half, with a base case for 2026 that sees the policy rate settling near 3.5% as inflation stabilizes in the mid-twos. In the Treasury market, aggressive declines at the front end versus a relatively steady long end have produced a bull steepening, consistent with more cuts being factored in while longer-term growth and inflation views remain anchored. Ample liquidity is also evident in cash and bond markets. Roughly $7 trillion parked in money market funds represents significant dry powder, and fixed income is seen in some quarters as offering reasonable value, with expectations for mid-single-digit total returns in 2026 largely driven by coupon income as yields stay range-bound. Rate cut expectations are supporting higher prices in metals such as gold and copper, and more broadly, the sense that central banks stand ready to cushion downside shocks helps explain why risk assets can tolerate bouts of strong data without a more severe repricing. Turning to the bearish side, elevated valuations and AI concentration are a growing concern. S&P 500 valuations are now near multi-decade highs, and much of the justification rests on expectations for massive AI-related capital deployment and productivity gains, leaving the index more exposed if those assumptions prove too optimistic. Market breadth remains narrow, with gains heavily concentrated in large-cap technology and communication services, while mid-caps, transports, and small caps have lagged, and leadership is still clustered in a relatively small group of AI-driven names. The AI trade itself is described as highly sensitive, with little margin for error. Trillions in projected data center and chip capex need to be executed on time and at scale to support current valuations, yet delays or failures in large infrastructure projects have already sparked sharp moves in individual stocks, as seen in recent reactions to rumors around key cloud and database providers. Analysts also flag that growth rates for leaders like NVIDIA are likely to slow from extremely elevated levels. Large language models are becoming commoditized, and energy constraints could cap the pace of capacity additions, all of which could compress the very premium the market is currently paying. Signs of complacency add to the vulnerability. The VIX at year lows and commentary about investors being heavily positioned for benign outcomes suggest that a negative surprise, whether from earnings, regulation, or macro data, could force a sharp correction, especially with liquidity thinner into year-end. On top of that, A potential wave of large AI IPOs in the coming years may test public market capacity, while moves such as Citadel deciding to return billions of profits to clients and the pronounced drawdown in crypto and related equities point to some sophisticated capital quietly de-risking at the margin. Another important bearish driver is rising geopolitics and safe haven flows, most visibly expressed through the behavior of precious metals. Gold has notched its 50th record close of the year and is trading at its highest 50-day level since the late 1970s, while silver also participates in a broad bull market, indicating robust demand for perceived safe stores of value. These moves are being linked to concerns about sovereign debt sustainability, lingering economic uncertainty, and expectations for further rate cuts, and they are increasingly being embraced by younger investors who view gold as a form of portfolio insurance. Geopolitical developments are amplifying that demand for hedges. There is bipartisan unease in the United States about the heavy concentration of semiconductor manufacturing in Taiwan, driving efforts to rewire supply chains and highlighting the risk of disruption in a key technology input. At the same time, U.S. policy toward Venezuela has turned more assertive, with actions targeting the country's shadow oil fleet and an increased military presence in the region, alongside a high probability being assigned to regime change, all of which raise the stakes for oil markets and regional stability. Currency and policy dynamics also feed safe haven behavior. Disruptions in global trade and the perceived weaponization of the dollar are discouraging some foreign holders from owning U.S. treasuries, which in turn supports demand for gold and silver as alternatives. In foreign exchange, persistent volatility in dollar-yen and repeated warnings from Japanese officials about a readiness to intervene underscore that policymakers remain on edge, adding another dimension of uncertainty that can encourage investors to hold more defensive assets alongside their growth exposures. The final bearish driver is stubborn long-term yields and policy doubts, which complicate the otherwise supportive picture from central banks. Despite around 175 basis points of Fed cuts over the past year, U.S. 10-year yields have risen by roughly 50 basis points, signaling a breakdown in the traditional transmission from policy rates to the long end of the curve. Global influences are part of the story, with higher yields in markets such as Germany and Japan feeding into U.S. rates and helping to keep term premia elevated. Inflation and policy divergence add to the uncertainty. The U.S. GDP price index has climbed to about 3.8%, above forecasts, while in Europe persistent core inflation and the risk of future energy shocks are seen as reasons the European Central Bank may not cut rates through 2026. Within the Fed, officials remain divided on the appropriate path for policy, and recent strong GDP data have reduced the odds of near-term cuts, even as other voices stress that failing to ease could raise the risk of recession, leaving markets with a wide cone of possible trajectories. For markets, this higher-for-longer yield backdrop carries important implications. Elevated and sticky long-term rates challenge equity valuations, reduce the diversification benefits of duration, and are one reason some see the traditional 60-40 allocation as less effective, prompting consideration of higher structural equity weights and a greater focus on alternatives. Counterbalancing this, the U.S. Treasury market has attracted new buyers, asset swap spreads have tightened, and some investors view long-dated government bonds as offering fair value with the potential for mid-single-digit returns over time, suggesting that while yields are a headwind, they may not be an insurmountable one. To sum up, risk sentiment remains broadly constructive as AI-driven earnings, resilient U.S. growth, and an ongoing easing bias from central banks continue to support equities and cyclicals, even with volatility pinned near the lows. Set against that, stretched valuations, concentrated leadership in AI winners, rising geopolitical tensions, and a stubbornly firm long end of the yield curve all point to a more fragile foundation than headline indices alone might suggest, making the path ahead highly sensitive to data, policy signals, and any execution missteps in the AI and energy build-out. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.